Onwards to the top story we're tracking this evening. In a surprising move, the RBI's Monetary Policy Committee decided to cut the key policy rates by 25 basis points. This was the first policy decision under Governor Shaktikanta Das, and remember, the first rate cut since August 2017. Now, 4 members of the committee voted in favour of the rate cut, including the new governor and the usually hawkish executive director at RBI, Michael Patra. Now, Deputy Governor Viral Acharya and MPC member Chetan Gate voted to a status quo. However, the MPC voted unanimously to change the policy stance from calibrated tightening to neutral. Now, the main reason for the rate cut is the RBI's benign inflation outlook. According to the central bank, prices of food items continue to surprise on the downside, and even electricity prices are showing moderation. So the inflation forecast for the first half of the upcoming financial year has seen a sharp cut from around levels of 4% to just above 3%. Now, the RBI also expects the economy to grow at 7.4% in FY20. It expects growth to remain just over 7% in the first half and then accelerate to about 7.5% by the end of the year. However, the central bank did also raise a lot of red flags. Now, the governor pointed to a slowdown in investment demand in the third quarter of this financial year. He also underlined that credit flow is slowing and there is a moderation of activity even in the services sector. Now, on the agricultural front, the governor said rabi sowing has been tepid and he expects total farm output to decelerate in FY19. Here are some of the highlights from the governor's press conference after his monetary policy debut.
The shift in stance of monetary policy from calibrated tightening to neutral also provides flexibility and the room to address the challenges to sustain growth of Indian economy over coming months, as long as the inflation outlook remains benign. The decisions of MPC in this regard will be data-driven and in consonance with the primary objective of monetary policy to maintain price stability while keeping in mind the objective of growth.
Whatever discussions happened at this press conference in December were more or less viewed by everyone as an effective neutral stance at that point of time. So I think you should just keep that perspective in mind, that we've experienced fairly large shocks on oil and food in a very short amount of time. One point in one sentence I would like to stress that is also mentioned is that at least as per some of the output gap measures, there is a small opening up of output gap, that the actual output has gone slightly below the potential. And as Governor said, because the inflation trajectory is kind of below the headline rate, the committee as a whole believed by majority that there was space for a rate cut as well this time.
We also spoke to Deepak Parekh, the chairman of HDFC, to get his verdict on the Monetary Policy Committee's decision today. And let's listen in to what he had to say.
Great news for the market. Rate cut is always better. Loans get cheaper, demand for loan increases. The pressure that is there on the financial sector today on some of the NBFCs and gets reduced. In any case, Reserve Bank has been very accommodative in open market operations. The last 4-5 months they have done large 30 to 40,000 per month. So the banking system has adequate liquidity. And with a lower rate cut, it's beneficial to industry, it's beneficial to the financial sector, and it's beneficial to our housing sector.
But the lenders that we've been able to speak to so far say there is no reason to bring down deposit rates or lending rates in a hurry yet.
The rates were already low. The margins had been really squeezed. And with the with non-performing loans shaping up and coming up, I think banks and NBFCs need to keep a larger margin for protection. So it's not possible for, because of heavy competition, the rates were wafer thin. And these kinds of wafer thin margins are just not viable today because stressed assets come up any time and you need larger profits to make provisions for. So part of it, the rate may be passed on, part of it is already factored in.
But how soon, given that, the position of the governor, it seemed that there's room for further rate cuts. The inflation projections have been brought down significantly.
The good news is the inflation is down, which is very good news. So if it's sustained over a period of time, then it's very good news for India. Particularly the inflation in India is always food and fuel.
Yeah.
Fuel inflation is beyond our control.
Yeah.
But the oil prices come down 30-40% from the 88 and 80 it had reached. It's 50s and 60s now, 50s, more manageable. So fuel inflation has come down. Food inflation has been extremely low. I have not seen such low food inflation now that we have in the past many years.
Yeah.
So there is cause for optimism. There is cause for the governor to say that there will be the stance is very positive, that further reduction may be possible in future.
But do you think all the imminent inflationary risks from the fiscal, slippage that, now for 2-3 years in the running, we've not been able to meet that glide path of 3%. Has that been factored in? Do you think that is a key risk that remains?
I'm not that worrisome. I've said that before about 3.3 or 3.4% fiscal deficit. So long as we have growth, we need 7.5 to 8% growth, and we are capable of even increasing that growth. If we can see growth and look at the number of infrastructure projects taking place across the country, 7 cities are doing metro, new airports are coming up, old airports are being privatized, the amount of road construction that the transport ministry is doing, affordable housing, massive construction boom. So I see cement companies started talking about putting up new facilities because cement capacity will be exhausted in the next couple of years to 3 years.